Every Monday morning at 7:15 a.m. Pacific Time, in my live streams, I am fully revealing my proprietary safe wheel strategy for free. Using my 28 years experience, I've developed the safe wheel strategy to cancel out the risks associated with the normal wheel strategy. I also designed the system to only need my attention once a week on Mondays and on rare occasions Fridays. And this is what I call a level 5 strategy. Now what you see on the screen is the trader matrix. I developed this to make it easy to distinguish between trading levels. After taking over 30 online stock and options courses, I've found that I'm the only level 5 trader that is not using portfolio margin. Portfolio margin is used for large accounts over $100,000. Now after 28 years, I've only found one edge in trading, and that is selling option premium. Level 5 trade systems are the only way to sell option premium efficiently and safely. For a better explanation of the 5 trading levels, see the link in the description for the video called The 5 Stages of a Trader. Okay, let's get started today first by doing a sound check. If you guys can hear me, please put it in the chat. Okay, got a yes. All right, so let's get going here. First thing I want to do is have you guys post any questions that you might have. You want to post those early because sometimes we get towards the end of the live stream and I miss your questions because they don't come up fast enough. All right, how did I do last week with the earnings edge alerts? That's always interesting to know, I think. So we traded CRM, and you can see that CRM's up $620 because we hit profit on that a few months back, and then we hit another $300 profit last week. So we hit another winner last week with the earnings edge alerts. My record is 14 wins, 3 losses, and 2 ties. So getting that 75% win rate looks pretty good. That's about where I'm at. And you can see the account that started with $5,000 is up to $6,539. So it's up over 30%. So it's doing quite well. Maybe slightly below what my goals are. And that probably has to do with the commission rate that I'm paying. You know, the commissions are pretty heavy with this, but things are on track with the earnings edge alerts. And of course, you can sign up for that. There's a link in the description. The next item I want to talk about is my P5, my Premier Level 5. Now with this is a complete system that controls second order Greeks, and it's non-directional. So if you want to control second order Greeks, be non-directional, and be in a profitable system, this is the place to be. This one took me about 4 years to develop after I was already in a mastermind. Now, this account's down about 1% approximately. Let's go to the chart here. I think we got in this on the 8th of April. So we trade the SPX. We only trade options on the SPX with this system. So the market's down about 7.5%, and we're oscillating down around 1% to even. Sometimes we're at the break even. We'll see how the month ends. But this is a great system. I only manage it maybe 3 times a month. So this is the best system out there. I don't see anything better. And of course, there's a link in the description for that. Now let's get into the safe wheel. That would be, I think, this account here. Okay, so we're dealing with Macy's. And what happened? Well, I was long 100 shares because I had been assigned And of course, with the wheel strategy, you sell a covered call. So I had sold a covered call that was pretty far out of the money, and the Macy's just shot up. I think it had earnings. So it just shot up significantly and took me out of my position. And now I'm left with these three long, these put hedges. You can see that they're down pretty good. So that's just part of the system, but also, I made pretty good money on those long 100 shares. I don't know the exact number. I don't have it in front of me, but it might be a couple $100 or something like that. I'm not sure. But the question is, what do I do next? First of all, do I stay with Macy's? Because I'm basically out of this cycle. The cycle's over because I was assigned shares. So it's time to get out, start clean. And am I going to stay with Macy's? So that's the first question. Well, Macy's is between 20 and 40. Macy's is trading at 23. So I am going to stay with Macy's because I like Macy's and it's got good liquidity. It's got good premium, and it's between 20 and 40. So I'm going to stay with Macy's. So the next question is, where do I put my put hedge? Well, if my put hedge is within 70%, so you want to be at least within 70%. So right now my put hedge is at the strike price of $17 put. And it's trading at $23. So 23 times 70% is 16. So it is within 70%. So I'm not going to roll it or start completely over. I'm going to use the existing put hedge that I have, and I'm going to keep that on. And you guys can ask questions about this if it doesn't make sense. Now, the next thing I'm going to do, now that I know I have my put hedge on already, I have my Macy's stock that I'm going to use, I'm going to sell a put. So let's go take a look at where I can sell a put. Of course, I'm going to go in the expiration cycle that expires this Friday. And I'm going to be looking at the puts. And I want to sell as low as I can, but I also want to make that 1%. So I could go anywhere from the 22 to the 22.50. Because currently the price is $23. So as long as I'm getting 23 cents or higher here. So I'm going to go here. I'm going to go to the 22. I'm going to sell one because I'm dealing with one contract, because $5,000 is one contract. So of course I want to get as much as I can selling this put. Let's see here, working orders. And we'll work the order. See if it gets filled. We'll have that open. Okay. Okay, so we got filled at $26. So now we have our put on. So now the next thing to do is protect this hedge by buying a long call in the same expiration cycle. So we're in the same expiration cycle and buy a long call. We're going to buy something around $5 or $6. Here's something right here. Try to get for $5. The $25.50. I'd have to pay $6 for it. Okay. All right, so there we are. We are beginning the wheel process, but we're hedged. So we sold our short put at the $22 strike. We bought the long call at the $25.50 to protect our put hedge. Now, how are we doing with this system? This system is up approximately 18% year to date. And we started on January 1st with a $5,000 account. So that's doing pretty good, obviously outpacing the S&P 500 with lower drawdowns too. Not bad on the drawdowns at all. Really haven't had much of a drawdown. But I expect this system to do about 10% per year. That's what the back test showed. And um, if you want to get more information, because I haven't gone over every single scenario when I've been trading the system, not every scenario's come up. So I do have a safe wheel guideline and flow chart, and I have that at a really good price. And you can get that through the link in the description. So that would give you that would answer every question that you had, because there's no way I can answer every question unless it comes up in the real live trading. Okay, so let me get into some questions now. Okay, good morning. Shovel says, cool Carl in the house. What's up, Shovel? All right. If you don't have enough capital, this is Jason here, for tier 2 shares, do you just take the loss? You should have $5,000 in order to run this strategy. If you don't have $5,000 to run the strategy, you should backtest your alternative strategy before you do anything. That would be my recommendations. Okay, Walter, I purchased a flow chart. In many places it says for greater than 1%. What is the time frame? So the time frame, if I believe that I understand your question, the time frame is we're trading in this first expiration cycle right here. So today's Tuesday, so typically we trade on a Monday. So when something expires at the end of the week, that's the time frame that we're dealing with. So 1% at the end of the week. So this one, when I sold the put, I wanted to get at least $23 right here, and it was in this expiration cycle here, the one that ends at the end of the week. Okay, Joel, when would be the best time to add the safe wheel position if you wanted to increase the size? Best time to add it. Well, I just started a new cycle right now, so you can follow the cycle that I'm in. And if you have $10,000, do 2 contracts of everything that I'm doing. Or if you have $15,000, do 3 contracts of everything I'm doing. All right. Bob, if the put hedge is between 2 strikes, which strike do you use? Upper or the lower? You could, at that point, you just kind of have to use discretion. If you're paying over $2, I would go with the lower one. But if you're probably paying under $2, I would go with the one that's closer. But you can go either way. Walter, do you give any consideration to the quality of the underlying? I'm not sure how you're talking about fundamental analysis, and I don't really believe in fundamental analysis unless you're talking about the long term, like 5 years from now. So I don't have any issue with the quality of the underlying. The quality of the underlying to me is good liquidity, enough premium to sell. Make sure there's enough premium in there out of the money. You can get that 1% out of the money, and the stock's trading between 20 and 40. That to me is quality. Okay, Charles, if we're just starting the safe wheel, do we buy the hedge you have? No, I would buy the one that's probably a little higher, maybe the 18, something that's at 80%. So $23 times 80%, 23 times 0.8. Yeah, what hedge do I have? The 17? I would buy the 18. Yeah. So that's what I would do. Payoff graph, please. Okay, let's take a look at that. Analyze tab. There you go. Let me make sure I have that all done correctly. Yeah, so there's your T+0 line. Where is the... Well, the problem is that the put hedge has already gone down in value. So this isn't totally accurate because it doesn't take into account the money I made last cycle, which includes the premium I collected, plus when I sold the 100 shares that I had for, I think, a couple $100 in profit. So this isn't totally accurate because it's not taking into account the past of what I've already done within this particular cycle. I call it the particular cycle because I'm still in that same put hedge, but I am starting a new cycle with that put hedge. So I don't know, hopefully that makes sense. Walter, I see silver on your list, and I've traded silver options for a wheel for about 2 years. The premium and liquidity are great. SLV. It's getting close there at $20. Let's take a look at it. So if you're talking $20 on SLV, if you want to sell a put, see, the thing is the liquidity is not really there because you want to be out of the money. So like 1950 and at least getting over 20 cents. So you're at the money and you're barely getting 20 cents. So silver for me wouldn't work for this strategy because there's not enough premium. Okay, Shannon, why don't you buy a long call? How come you don't buy a long call when you buy the put hedge? You mean like in a combination? Like buy them all together? Like as a spread? I mean, I guess I could do that, but I want to kind of break things up to make it more simple to understand. Walter, a similar stock, AG, trades highly correlated with SLV, but without twice the premium because of increased volatility, but it's below $10. What are the caveats in trading the wheel with AG? Well, it's got to have enough premium, which you just said it probably doesn't. And it's not between 20 and 40. And that's the way I like to size it based on a $5,000 account. So there's a couple of problems with it with AG. Walter, thanks for the backtest and delta neutral strategy video. Oh, you're welcome. I appreciate that. Jason, to ask the question a different way, you probably couldn't do the safe wheel for a $25 to $30 stock with 5,000 because you couldn't afford to hold the 200 shares. Yeah, so you need to have a margin account. Make sure that you have a margin account before you trade the safe wheel. Hopefully that answers your question, because we do use margin. Okay, I think that's it for the questions. Regular margin, yes, regular margin. No special span margin or portfolio margin or anything like that. Just Reg T margin. That's all you need. All right, any more questions? Okay, I have one thing to say. Okay, here we go. Shannon here is trying to ask again. Let's see. I'll ask another way. When you buy your $17 puts, 17 strike puts, rather than buying a call each week, why not buy a November call? Oh, I see. So you're saying to protect those puts, I buy a call in the same expiration cycle as the put hedge. Well, the problem with that is it won't protect it because for $5, I'm not going to get anything close to that $17 strike. So that's why I come in all the way into the nearest expiration cycle. So for $5, I can get something relatively close. So I hope that answered your question, Shannon. All right, we're going to wrap things up now. One thing to say, if the P&L is not real, what else are they trying to conceal?